Hi, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today, we want to talk about a particular asset class that we've been using for quite some time, over 20 years now, an asset class called convertible bonds. It's in the fixed income family, but it's got a little bit of a twist. And so we want to talk about its role within our portfolio and why we've chosen it, what it is, and just how it fits in the whole context of the bond family.
So what's interesting, Laura, is that I'm stunned that more advisors don't use this asset class. I don't think I've seen hardly any other advisor that actually uses it in my travels, which is interesting. And I don't understand why, especially when we're going to show everyone later the risk versus return profile of this asset class.
We're actually going to talk about this today a little bit, and also in our next conversation where we talk about our enhancer asset classes, because I'm stunned that more people don't use any of the enhancer classes that we use, because there's such a fundamental need to do that. And I think that's really part of our value added, a large part of our value added, because we're able to use these asset classes to really adequately diversify and help reduce risk in people's portfolios.
Yes, and so right here we've been using this almost looks like a flow chart, but it's sort of a classification of different types of bonds, and we have at the one coming out roughly in the middle. You see the non-traditional bond categories, and I think last video we talked about reinsurance catastrophe bonds. Could have been the video before last, and now today we're going to talk about convertible bonds, which are also a non-traditional asset class.
Steve, we're missing one there too, an additional alternative lending that we've actually added, which could theoretically be the types of bonds. Although again, I want to state that even though we're showing them under this bond world, we classify them, if you look at your performance reports, for example, we classify them as an enhancer asset class. So it kind of is a bond, but it kind of is a little bit more than a bond.
Yeah, the only reason I left out Lendex, which Laura's referring to, is it's actually backed by loans, so I don't really consider it quite a bond fund, though it is a fixed income category, though, certainly. Okay. And so convertible bonds, which is actually pretty interesting, have been around since the 1800s, which is pretty stunning, a long time. And what's amazing is their return has been very close to the S&P 500, going back, and you're going to see this soon. We're going to show you the data, years and years and years, at least as far back as the data we have on convertibles. And the risk, though, is about 60% of the risk of the S&P 500, which is a stunning combination. The return's close to the S&P, but the risk is only 60% of it. And that's amazing, especially when you consider that most convertible bonds are actually lower rated bonds, because you have to think about who issues convertible bonds. They're typically issued by companies that may not have as much access to credit as a larger company. Additionally, they want to get credit with a better interest payment. They want to have lower interest, of course. They want to pay less. So what they do is they issue these convertible bonds. And the key with the convertible bond is that these bonds actually have a, some people might call it a call option. Call option is an option that allows you to take stock away from somebody, but it's sort of like a call option, but not quite. But they have an option associated with them that allows you to convert the bond into the stock of the underlying company. And usually it's a unilateral decision. The investor in the bond can decide when to execute that conversion.
So Steve, if I could just actually add a little bit to that, I just really wanted to talk about why an issuer would even use convertible bonds. It is a flexible source of capital, and for growing firms who are still looking for financing to support their growth, convertible bonds are very attractive because they're not forced to pay these higher rates. Like, for example, they might get away with paying a more competitive rate by adding the convertible feature. And it's, of course, less dilutive than straight equity. So it's very, very attractive. And when I actually did some research on what types of firms will actually use these convertible bonds, they tend to be about 2/3 of the companies that have issued out convertible bonds most recently have been recently listed within the last year or 3 years. They're new public companies that have kind of come up, and so they're still proving themselves, and that's part of the reason why they need to use some kind of creative financing, and they offer these types of bonds. So they're not necessarily, I guess I was under the impression at one point that they were distressed companies, and it's not necessarily that they're distressed companies. They're just companies that aren't so well known and so well proven, and they just need this extra incentive to get people to invest.
Yeah, they don't have as ready access to the credit markets. And so they do it this way. By the way, they were up about 50% last year, which you'll see, I think, and we might have this slide, actually, maybe the next group of slides. But they were up 50% last year, and no small part, I believe, because of Tesla. It's one of the convertible bonds that were in their holdings we have.
Twitter was issuing convertible bonds. A lot of these newer companies that people know about that have great potential offer these convertible bonds, which is why it does translate to such definitely more growth companies, right?
Yes, definitely.
Post value companies.
Yeah. And so, by the way, I want to mention that we don't like high yield bonds because to us, they have the worst of most characteristics in that they're low rated bonds, as are convertibles. But the problem with high yield is there's no real potential upside with high yield bonds other than the coupon payment you receive. But there's a lot of potential downside with defaults, which have averaged 6 to 8% annually with high yield. At least with convertibles, even though they may be lower rated, you have enormous potential upside here with convertibles. And we've seen that time and time again, as you'll see. And now on the slide here, by the way, there's some of the characteristics and key, I would say, definitions that apply to convertible bonds that are really important to look at. Maybe, Laura, do you want to talk about them? Or do you want me to?
Sure. Well, I mean, just a lot of people will ask about conversion ratio. I know that's an important aspect. And usually what they'll say something like, for example, 45-1. And what they mean is that if you have a par value convertible bond, where it has that kind of conversion, that if you convert, you'll get 45 shares of the stock, the underlying security of that particular issuer. And so the conversion ratio, of course, is a big thing. The conversion price, I mean, I guess, it's really, again, I mean, you have that conversion ratio gets folded into that. I don't know. What do you want to say about that without getting too?
Sure. Yeah, I can make it pretty simple with that. So, for example, I like to take a nice round number and say, argument's sake, say the conversion ratio is 20, and most bonds, when they're issued, the par value is $1,000. So that means effectively you can convert that $1,000 bond into 20 shares of the stock. So of course the break-even price would be $50 a share. And so if it's less than $50 a share, the underlying stock, you're not going to convert because you're going to be giving away something that's worth nominally $1,000 for something that's maybe worth, argument's sake, if it's $40 a share, $800. What you're going to do is you're going to watch that stock and say, oh, gee, suddenly it's up to $60 a share. And then with the 20 shares I can convert it into, suddenly I can get $1,200, which is not bad. So you turn your $1,000 bond into a $1,200 position in the stock in the company. And we're going to show shortly how this affects the pricing of these bonds. Okay. And there's this other thing called the issuance premium. That's the markup of the conversion price over the current market price. Okay. And we'll show you that in a little graph we have here. And so this is to go back. This is the equation. The conversion price is the bond's par value divided by the conversion ratio. And the conversion value equals the conversion ratio times the share price, which we sort of just talked about. Okay. So how do you actually value a convertible bond? Well, when the share price is below that conversion ratio, or should say the equivalent value of the stock versus the bond is going to be priced like all other bonds. It's going to be based on its yield to maturity, its credit rating, its coupon, those factors. But suddenly now, what happens is when the the shares price starts to go up, now suddenly, even if you don't convert the bond to the stock, now the bond price starts to rise like the stock, like the underlying stock. So in other words, now your bond, even if you don't convert, is acting like a stock. So this is really nice. It means that you sort of have a floor on the value of this security in a really bad market. Okay, so if you haven't converted, it's going to have a value based on its bond-like characteristics. But in a really good market, it's going to act like the stock market, and it's going to rise with the stock market.
It's interesting. I actually think of this almost as a less expensive way of having an option strategy using puts and calls.
Yeah,
is more kind of efficient and effective.
yeah, I completely agree. And by the way, I just want to mention, we'll talk about it a little later, but we use a couple of ETFs to gain exposure to this. Low-cost ETFs with low expense ratios. So here's the historical performance. So you can see here convertible bonds, and we went back as far as we
register in terms of the change on the. I'm still looking at the value.
I'm sorry, I have to move the other screen. Sorry. So the convertible bonds, as you can see, now we're using data that goes back as far as we can get for convertible bond indices, and this is not historical performance of any fund. These are indexes. And so convertible bonds average over 11% a year return, going back as far as we can track them back, which is phenomenal.
The S&P.
Yep, it's all very close to the S&P. But look at the risk level. It's about 60% of the S&P, which is pretty stunning, considering. I mean, that is a phenomenal risk versus return profile. And so we also show something called the Sharpe ratio, and that's the Sharpe ratio is a key metric that you can sort of use to sort of identify how efficient an asset class is. In other words, it's return versus risk profile. You can calculate simply by just taking the historical rate of return, subtracting from it the risk-free rate, which is the Treasury, and then dividing it by the standard deviation. And if you look at the Sharpe ratio of convertible bonds, it's about 50% higher than the S&P. It's higher than small cap, and it's higher than international stock, which is what I don't understand why more advisors don't use this asset category. And we've been using it since 1995, by the way.
And the thing is that too, when we look at the comparisons of top performing asset classes over the years, over the past 20, 25 years, it's been one of the top performing asset class a large percentage of the time. I mean, even when I looked at the comparison over fixed income, it's been the top performing fixed income asset class for the past 10 years. I think 6 years out of the past 10 years. This year, it's what, up 7%? You said last year was up 53%.
50%. Who knew?
Yeah, the year before too, in 2019, it was even up like 23%, 22, 23%. So
Yes.
It's been a really strong performer for a long time, not just recently.
And I want to throw in our usual plug for about not timing the markets, because when I said who knew, I don't think there's anybody who could have predicted that convertible bonds would be the best performing asset class last year. And we certainly could not have. But like I said, we've always held this asset class since I started managing money, I think in 1995. In my research, I said to myself, I read a number of academic papers on it. I said, wow, this is a great asset class. And at that time, we had to gain more access to it through active managers. And over the years, we've found ETFs instead that are not active managers. And their return is close to the indices, which is what we want. We want to capture that risk versus return profile, the one you see here. And that's its purpose in the portfolio.
And so when we do our analysis, one of the things that we always talk about with these asset classes is what is the primary source of risk with this asset class? Because all asset classes have a source of risk, otherwise they wouldn't have a corresponding return. And for this asset class, there is an element of risk. Usually it would be default risk.
Yes.
Might be one of the
Credit downgrade risk.
Right. Interest rate risk is a little bit mitigated by the call feature, right?
Mm-hmm. Yes.
So whereas some of the bond pieces that we hold are all about like definitely, because we usually like to have investment grade, it's all about interest rate risk. So, making sure that we've really spread out the kinds of risks that we're exposing you to is really key for us.
Yep. And that, I think, is all we have in this video.
Okay, so we've talked a lot about, we have other videos on all our different views on the different kinds of fixed income that we hold. Bonds, I don't know if we've actually talked too much about international bonds, so I suppose we could still
We have not. No.
about international bonds.
Yes.
We may want to talk a little bit about alternative lending, which, as Steve mentioned, is in the bond family, but it also has other aspects to it. But we continue to look for these additional asset classes that will enhance our portfolios, and enhancing means give us more potential upside while reducing risk, because risk is fundamental.
That is, yeah.
Want to thank you for listening to our video. And if you have more specific questions on convertible bonds, of course, Steve and I can talk all day about them and give you a lot of detail. However you would like to get additional information, we're available. So thank you and have a great day.